Hello everyone, good morning, good afternoon, good evening, depending upon when you are watching this video lecture. In the earlier sessions related to capital structure, we discussed about different theories of capital structure, some of them relevance theories, some of them irrelevance theories, and we also solved some of the numerical questions related to the capital structure theories. Now, let us move on to another aspect in this chapter, that is EBIT EPS analysis. So this analysis will definitely lead to or tries to lead to optimal capital structure, and ultimately, since the objective of financial management is to maximize the wealth, always the decisions related to capital structure should be taken in such a way that they maximize the wealth of shareholders. For this purpose, we can do EBIT, EPS, MPS analysis. EBIT, earnings before interest and tax, and EPS, earnings per share, MPS, market price per share. So how to get market price per share when you already have EPS? Multiply EPS with the PE ratio, that is price earnings ratio, or even divide it with cost of equity, that is another way to arrive at market price per share. In general, the first way is used to compute market price per share. If that is not given, if cost of equity is given instead of price earnings ratio, we know that these two can be considered as if they are reciprocals to each other, because we know that one of the ways of computing cost of equity is earnings yield approach. So P by E, if you reverse it, it is E by P. So E by P is basically cost of equity. So that's why we can arrive at market price per share by multiplying EPS with price earnings ratio, or by dividing EPS with cost of equity. Either way, market price per share can be arrived at, but ultimately the objective is to maximize the market price per share. So if at all there are some alternatives given, different possible capital structures given, different sources of finance given, then which will be the best plan, which will be the one to be chosen? Obviously, which enhances the market price per share. That is the decision making process. EBIT, EPS, MPS analysis will lead us to such kind of decision. And there can be another type of analysis that is called indifference point analysis, which tells us about which EBIT will give same type of EPS irrespective of the capital structure. So that can be indifferent analysis. Also, financial break-even point analysis also can be done. See, normally break-even point means the coverage of fixed costs, but here financial break-even point includes majorly the financial fixed cost, that is interest. So these three analysis, EBIT, EPS, MPS analysis, indifference point analysis, or financial break-even point analysis, will lead us to an optimal capital structure. First, let us start with EBIT, EPS, MPS analysis, which is an important model of questions. Many a time these questions were given in the examination. So definitely one of the most important aspects in this chapter will be this EBIT, EPS, MPS analysis. So what is this basically? Actually, it is just a simple calculation. When EBIT of the company is given, we need to calculate EPS and also MPS depending upon the information that is available to us. So how to calculate EPS? We know that. How to calculate MPS? We know that. Both of them have to be just applied in the computations. What does it give us? Finally, it gives us which alternative financing plans will lead to a maximum market price per share, or if market price per share is not the concern, maximum EPS at least. So whichever the option gives the best EPS, that will be the selected option, that is better option to be selected. So let us apply this EBIT EPS MPS analysis. All the times MPS may not be there, but EBIT EPS will be there in most of the questions. Let us start with this illustration number 10. Suppose that a firm has an all equity capital structure consisting of 1 lakh ordinary shares of 10 rupees each. That means they have an equity share capital already of 10 lakhs rupees. The firm wants to raise 2,50,000 rupees to finance its investments and is considering 3 alternative methods of financing. It has 3 alternative methods of financing under scrutiny. 1, to issue 25,000 ordinary shares of 10 rupees each, automatically you will get 2,50,000. 2, to borrow 2,50,000 rupees at 8% rate of interest. Borrow means this is debt, so interest rate is 8%. Or third alternative is to issue 2,500 preference shares of 100 rupees each at an 8% rate of dividend. So 3 alternative plans are there, either equity or debt or preference. Any of these plans will have to be selected. One of them has to be selected. Now, if the firm's earnings before interest and taxes, which is EBIT, after the additional investment are 3,12,500, means after doing this 2,50,000 investment also, then what is going to be the new EBIT of the company? That is going to be 3,12,500. Tax rate is 50%. Find the effect of the effect on the earnings per share under the 3 financing alternatives. That is the question. So of course, in examination, you have to put a proper heading, statement showing evaluation of 3 financing alternatives. Alternate 1, which is equity. Alternative 2, which is debt. Alternative 3, which is preference shares. You have to write that clearly. This is equity alternative, this is debt alternative, this is preference shares alternative. So first thing first, we have to start with EBIT. How much is going to be EBIT? That will be same. That is going to be 3,12,500 only. In any of the financing alternatives, it will not have impact on the operating income. Operating income is still the same. That is same 3,12,500. But only in one alternative there is interest. Which alternative? That is debt alternative. In equity alternative and preference alternative, there is no interest. Only in debt alternative, there will be interest. How much will be the interest? That has to be calculated. How much? 2,50,000 multiplied with 8% interest. So 20,000 rupees interest. After that, what we will get? EBT, earnings before tax. So whatever 3,12,000 minus interest will give us EBT. This has to be calculated. It will be same as EBIT in alternative 1 and 3, but in alternate 2, EBT is 2,92,500. Then of course, we have to deduct taxes. How much is the tax rate given in the question? 50%. So whatever is the EBT on that 50% will be tax. This has to be calculated. Then what is going to be earnings after tax or profit after tax? Profit after tax is this minus this. Or if you want to take this as a negative amount, to show it clearly, after tax profit will be same thing as tax, because 50% tax rate is there. 156,250, 146,250, 156,250. That is profit after tax. Now, in case of first alternative, there is not going to be any preference dividend. Second alternative also there is no preference dividend. But third alternative there will be preference dividend. So, what is going to be the preference dividend? As given in the question, 2,500 preference shares of 100 rupees each, means same 2,50,000 is raised with preference shares issue. 8% on 2,50,000 is once again 20,000. Just to show which is to be reduced, which is to be added, I'm showing it color combination. You don't have to do that in the exam, you cannot do that also. So here preference dividend is 20,000. After deducting the preference dividend, what we'll get is called earnings available to equity shareholders or profits available to equity shareholders. What will be that? Profit after tax minus of preference dividend. So for first option, 156,250 is the profits available to equity shareholders. Second option, 146,250. Third option, 136,250. Then how to get EPS? That's what we want. Ultimately, what is the question here? Find the effect on the EPS. So how to get EPS? For that purpose, we need number of shares. Number of shares will be how much in each of the alternatives. See, already the company has 100,000, 1 lakh equity shares. You cannot ignore that. You cannot take only the extra shares issued. All shares to be considered. So 1 lakh is there already. But in first scenario, the company will issue 10 rupees per share. Like that, 2,50,000 rupees. That means it will issue 25,000 new equity shares. So 1 lakh plus 25,000. Obviously, in the first scenario where company issues fresh equity shares for its financing options, 1,25,000 will be the number of equity shares in alternate 1. What about alternate 2 and alternate 3? 1 lakh only. Why? Because in alternate 2 and 3, no new equity shares are issued. So equity shares will remain as original. Originally they were 1 lakh. They will remain to be 1 lakh. Now simply how to get EPS? Earnings available to equity shareholders divided by number of shares. That will be EPS. So take at least 2 decimals. 2 decimals is enough. 1.25, 1.46, 1.36. That is the earnings per share under 3 different alternatives. Just what is the effect on the earnings per share? Certainly, in case of the debt financing in alternate 2, earnings per share is highest. This is the highest earnings per share. How was that possible? How this highest earnings per share was possible? Because again, the cheaper cost of debt was only 8%. That too, it has a tax benefit. So the return to the equity shareholders will be more when the company uses financial leverage. That is a common principle, and that can be shown here with example wherein debt financing has given more EPS. But of course, conditions apply. When the company's earnings before interest and tax are more than its cost of debt, means the basic return that the company gets on its investment is more than the cost of debt. Company, if it is able to service the debt very well, then only it will be highest. Now, just for understanding purposes, let us say, if at all we want to get MPS in all the 3 options, PE ratio can be different. PE ratio in the first option, let us say it is 10. Multiplying with EPS, we will get 12.5 MPS. In the second option, if PE ratio is 8, then MPS will be 11.68. In the third option, if the PE ratio is 7, then market price will be 9.52. So PE ratio has to be given in the question. Just what you have to do is just multiply that PE ratio with EPS so that you can get market price per share. It need not be same all the times. In different options, different PE ratios also may be there, because the investor's perceptions will change according to the capital structure also. So if one PE ratio is given, then same PE ratio will be used to multiply with EPS. If different PE ratios are given, we have to use them. As an example, this is the situation. So now, if at all we take the same example, in fact, though the EPS is lower in alternate 1, MPS is highest in alternate 1. So which has to be chosen? Alternate 1 only has to be chosen still. Why? Because market price per share is the ultimate goal. Market price per share is nothing but that is the shareholder's wealth. So that is why P ratio also plays a crucial role in determining finally the capital structure decision. If you take only on the basis of EPS, then alternate 2 looks better than others. But if you take MPS as the basis of the selection point, then alternate 1 looks better option because it has more market price per share, because it has more P ratio also. That is not in the hands of management, that is not in the hands of anybody. PE ratio is something that is in the hands of the market. What is the perception of the investors about the company? So that will determine P ratio. That will automatically will tell us which kind of capital structure, which kind of source of finance will maximize the MPS. In this case, alternate 1. Now let us look at another situation wherein you have to do this, redo this again. What if when the EBIT is not 3,12,500, means EBIT is much lesser than earlier? Then what happens? Let us recalculate this. If let us 75,000 only is the EBIT, then what happens? Then everything will change. But interest will still be same. Tax rate will still be same. Profit after tax will change. Now what happened? The EPS also changed. How the EPS has changed? If you take 0.3, you have to redo that. 0.275, 0.175. Right? So what happened here in this scenario? In this scenario, which is giving a best EPS? Equity is giving best EPS. That's what happened. Equity is giving best EPS, not debt. Why debt is giving less EPS than equity in this case? Because EBIT is lesser. The company's operating income is lesser. So simple logic. When the unfavorable conditions are there, that means when the rate of return on the total assets is less than the cost of debt, earnings per share will fall with the degree of leverage. Of course, which leverage? Financial leverage. So earnings per share is not going to increase with the leverage. It is going to be actually lesser than that equity option when this is an example of unfavorable conditions. Unfavorable condition here means lower EBIT. Earlier example, 3,12,500 EBIT was a favorable condition because it was earning, the company was earning, or rate of return on the investment of the company is much higher than the cost of debt. So where the extra earnings over and above the cost of debt will go to naturally equity shareholders. So when the debt is used, that is why return on equity will be more. When the company's earnings are good. If they are not good, if the company is not performing well, operating income is, let us say, lesser, then that same debt will be counterproductive. The debt will hamper the EPS, that will reduce the earnings available to equity shareholders and naturally EPS also. That is the EBIT EPS analysis. Now, financial break-even and indifference analysis. Let us see that. What is this financial break-even and indifference analysis? Simple. As we know, at different levels of EBIT, one kind of source of finance is better than the other source. Naturally, when EBIT is in the lower segment, equity is better than debt because equity line is higher, debt line is lower. So when EBIT is lower, then equity is better structure, better source of finance than debt. Debt will be counterproductive. When the debt will start giving its benefits after reaching the indifference point, after the EBIT increases beyond indifference point, then debt will give more EPS than equity. So up to this indifference point, equity is better than debt. After this indifference point, debt is better than equity. But what happens at indifference point? That is the level of EBIT at which EPS of both the options, in fact all the options, all financing options will be same. That's it. So that can be considered as the definition of this indifference point. That is the level of EBIT for the companies. All types of capital structures will give same EPS. So whether you take debt also, equity also, the EPS is going to be same. At what level of EBIT that happens, that is called as indifference point. So how to calculate this indifference point? we can easily calculate it by using this formula. So we have to take same EBIT because that is what we want to calculate, that is indifference point. But interest is different in one alternative and different in another alternative. So EBIT minus interest will give you obviously profit before tax. Multiplied with 1 minus tax rate will give you profit after tax. That is the earnings available to equity shareholders. Divided by E1 is the number of equity shares in alternate 1. So we are talking about only two alternatives. Any two alternatives, in between them only we can take indifference point. So any two, equity and debt also, equity and preference also, preference and debt also. Like that, any two alternatives we can calculate this indifference point, but only two at a time. Third alternative cannot be brought here. So if alternate 1 is used, how much is going to be the EPS? But since we don't know the EBIT, that is what we want to find out. We apply this in the formula. EBIT into EBIT minus interest amount in alternate 1 multiplied with 1 minus tax rate divided by E1. E1 is number of equity shares in alternate 1. Then that should be equated to EBIT minus I2. I2 here is interest charges in alternative 2 multiplied with 1 minus tax rate divided by E2. E2 means number of equity shares in alternative 2. So if we apply this formula and equate them, EBIT we don't know. That's what we have to find out. I1 we will know. E1 we will know. Tax rate of course we will know. I2 and E2 also we will know. Substitute them. Solve it for EBIT. That will be the EBIT level at which both the financing options will give same EPS. We are equating the EPS under both the financing options. That is called indifference point. Sometimes there may not be indifference point, possibly, because these two options may have always a parallel relation with each other. Plan 1, plan 2. In this situation is an example where plan 2 is always better than plan 1. There is no way that the plan 2 can be equated with plan 1. For example, let us say there are two plans, both are having 1 lakh equity shares, 1 lakh rupees worth of equity shares. Plan 1 is having 10% debentures of 50,000. Plan 2 is having 8% term loan of 50,000. So plan 2 is always better than plan 1 because it has a lower rate of interest. Same amounts, everything same. So plan 2 and plan 1 can never be equated. That means what? There is no possibility of any indifference point in that case. No indifference point will come in those cases because always plan 2 will be better than plan 1 as an example. In this case, why plan 2 is better than plan 1? Because plan 2 has a lesser rate of interest and all amounts being same. Equity shares also same. So we cannot draw or we cannot come to any indifference point in such situations. That is one exception. Another exception can happen where many indifference points can be there. When? If after tax cost of the sources other than equity shares is same under both the plans, then each EBIT will be indifference point. Let us say there are two different plans. If the after tax cost of the sources other than equity shares is same, then EBIT will be, any EBIT will be the indifference point. That means there also we cannot have any one particular indifference point, any line, because these two lines of plan 2 and plan 1 are coinciding. See, normally when an indifference point will come, there is one plan, there is another plan, and one plan is better than the another plan up to some point, second plan is better than the first plan after some point. Then there is an indifference point where these two will have an intersection point. What if they are parallel? There is no way there can be an indifference point. What if both lines are colliding, coinciding with each other, as is the case in this diagram? Then also there is no possibility of defining indifference point. Then we can say many indifference points. Every EBIT is an indifference point, which is undefinable. It is not indefinable. We cannot define the indifference point in that case also. These are two exceptional cases. Other than that, normally we should be able to calculate indifference point using the data available and of course the formula that we know. Let us solve this illustration number 11. Best of Luck Limited, a profit-making company, has a paid-up capital of 100 lakhs rupees consisting of 10 lakhs ordinary shares of 10 rupees each, that is already. Currently it is earning an annual pre-tax profit of 60 lakhs. Each word has to be carefully read. The company's shares are listed and are quoted in the range of 50 to 80. That is the range of the market prices the company's shares are being quoted in the stock market. The management wants to diversify production and has approved a project which will cost 50 lakhs and which is expected to yield a pre-tax income of 40 lakhs per annum. That comes only from this project. That particular project will give 40 lakhs rupees pre-tax income of 40 lakhs will come from that project. To raise this additional capital, the following options are under consideration of the management. As usual, more or less always the question will be same. The company wants some financing. It will go for different options or alternatives. Then one of the alternatives are to be chosen or indifference point has to be calculated, whatever is asked in the question. Now, what are the options here? First option is to issue equity share capital for the entire additional amount. It is expected that new shares of face value can be sold at a premium of 15 rupees. Read it carefully. Premium of 15 rupees means what is the issue price? That is 25 rupees, not 15 rupees. It is not the price 15 rupees. Premium of 15 rupees on face value of 10 rupees means issue price is 25 rupees. First of all, how much investment we need? That first of all we should know, that is 50 lakhs. So if you need 50 lakhs rupees investment, each share is 25 rupees if you can issue. How many number of new shares you have to issue? That is 2 lakhs. That has to be calculated as a working note. 2 lakhs. Then that is option 1. Second option is to issue 16% non-convertible debentures of 100 rupees each for the entire amount. Okay, debentures of 100 rupees each for the entire amount once again. So entire amount means entire 50 lakhs is going to be issued with debt. So that is one more option. Third option is to issue equity share capital for 25 lakhs with a face value of 10 and 16% non-convertible debentures for the balance amount. In this case, the company can issue the shares at a premium of 40 rupees per share. Now, what is the issue price? 50, because premium is not 15 rupees anymore. Here it is 40 rupees premium. That means 10 rupees face value plus 40, 50 rupees is the total issue price. But how much is going to be raised? Only 25 lakhs like that. That means how many shares are supposed to be issued extra? 25 lakhs divided by 50. That will be 50,000. The number of shares are supposed to be issued. So in option 1, 2 lakhs equity shares are issued, full equity. In option 2, full debt, that is 100% amount raised in the form of debt. Option 3, half debt, half equity. In this case, equity will have to be issued. How much of number of equity shares are to be issued? 50,000 number of equity shares are supposed to be issued. That's all. That is the basic calculations. We can show them in the working note and keep it ready. What is required here is calculate the additional capital that can be raised, keeping in mind that the management wants to maximize EPS to maintain its goodwill. Company is having an income tax rate of 50%. So additional capital actually calculate is not the point. Which of the options is better? That should be the question. So there are 3 alternatives. Which option will give better EPS? Ideally should be the question. So let us take the same type of calculations. Same type of situation. So what are the alternatives here? Statement showing evaluation of financing alternatives, that is all same. Now, what are the alternatives here? First one alternative is full equity. Second alternative is full debt. Third alternative is equity and debt. That is the third alternative. Now, what is going to be the pre-tax income in each of these alternatives? That we have to observe in the question carefully. So currently it has an annual pre-tax profit of 60 lakhs. That is 60 lakhs already there. Plus, in addition to this, if the new project is introduced, then 40 lakhs pre-tax income can be generated. So the EBIT, if the new project is implemented, will be 40 lakhs extra. So 40 already, 60 already there plus 40. That means 100 lakhs is the EBIT. 100 lakhs means 1 crore. 1 crore is going to be the EBIT in each of the three alternatives. Then what happens in alternative 1? Currently the company does not have any debt. There is nothing given. Profit making company has a paid up capital of 100 lakhs rupees, all equity shares only. So how many equity shares are there already? 10 lakhs equity shares, number of shares that is, are already there of 10 rupees each. That means 100 lakhs rupees paid up capital is there already. And pre-tax profit already we took it. Market price currently we don't care. That doesn't have any direct relevance. Now, alternate 1 if it takes, is there going to be any debt? No, because it is pure equity. So is there going to be any interest? No. So what is going to be the earnings before tax? Same as EBIT. Tax is given. Tax rate is 50%. That means 50 lakhs. So what is going to be the profit after tax? 50 lakhs in alternate 1. Alternate 2, 16% non-convertible debentures of 100 rupees each are going to be issued for the entire amount. How much is the entire amount? Means 50 lakhs. On 50 lakhs, interest is there. On 50 lakhs, 16% interest rate is there. So 8 lakhs is going to be the interest in the second alternative. So obviously, what is going to be the earnings before tax? That will be 92 lakhs. Tax will be 46 lakhs. Earnings after tax or profit after tax will be 46 lakhs in alternate 2. Coming to alternate 3, debt is issued only for 25 lakhs. Equity is issued for remaining 25 lakhs. So 25 lakhs, not 50 lakhs, 25 lakhs multiplied with 16%. Amount of rate of interest is same, 16%. So 4 lakhs is going to be the interest. Naturally, the earnings before tax is going to be 96 lakhs. Tax will be 48 lakhs. And then profit after tax is 48 lakhs also. That is alternative 3. In all these alternatives, what is the number of equity shares? That will be different. But anyway, the same profit after tax is the earnings available to equity shareholders also. Why? Because there is no preference shares. So profit after tax is earnings available to equity shareholders. Same thing will be earnings available to equity shareholders also. Now what is important to compute EPS is number of shares. In alternate 1, how many new shares are supposed to be issued? Already we calculated and kept it ready, 2 lakhs. But already how many shares are there? 10 lakhs. That means total shares will be 12 lakhs. 12 lakh shares are there in alternate 1. Already 10 lakhs plus 2 lakhs. Alternate 2, original 10 lakhs will continue. No new equity shares are issued. In alternate 3, 10 lakhs are already there. Additionally, 50,000 shares are supposed to be issued as we already calculated. So these will be the number of shares in each of the alternatives. So naturally, what will be the earnings per share in each of these alternatives? If we calculate for 2 decimals at least, 4.17, 4.6, 4.57. So 4.17, 4.6 and 4.57. So obviously, which is best one? Option 2 is best, where entire amount is raised through debt, because it is giving the maximum EPS. That's all. Just one line conclusion. Don't write stories. Okay. That is EBIT EPS analysis. Now, let us do another question. Illustration 12. Shaji Steels Limited requires 25 lakhs rupees for a new plant. That is the money they are requiring. This plant is expected to yield earnings before interest and tax of 5 lakhs. While deciding about the financial plan, the company considers the objective of maximizing EPS. Like any company, same thing. It has three alternatives to finance the project. One, by raising a debt of 2,50,000 or 10 lakhs or 15 lakhs. And the balance in each case by issuing equity shares, which means in all options there is debt and equity, but how much debt, how much equity, that is changing. So just for understanding purposes, what are the three alternatives and how much money to be raised as debt and how much money to be raised as equity? So one option is raising 2,50,000 as debt. Second option, raising 10 lakhs as debt. Third option, raising 15 lakhs as debt. That means balance has to be raised by equity naturally. So in first option, how much equity has to be raised? 25 lakhs is your requirement. So naturally 22 lakhs 50,000 will have to be raised through equity. In second option, 15 lakhs has to be raised through equity. In third option, 10 lakhs has to be raised through equity. Total in all cases of total financing that is required is 25 lakhs. That is the three different alternatives with debt and equity combinations. All of them are having debt also and equity also, but different proportions. Now, the company's share currently selling at 150 rupees, but it is expected to decline to 125 rupees in case the funds are borrowed in excess of 10 lakhs. Borrowed means if the debt crosses 10 lakhs, in excess of 10 lakhs, not 10 lakhs, then the price of the share is going to fall to 125 rupees. The funds can be borrowed at the rate of 10% up to 2,50,000 and at the rate of 15% over 2,50,000 and up to 10 lakhs and at 20% over 10 lakhs. So the interest rate is also not same. Depending upon the debt that we raise, the interest also changes. Tax rate applicable to the company is 50%. Analyze which form of financing should the company choose. Of course, working notes will be required definitely. Here, how many number of shares are going to be issued, how much of interest is going to be there in each of the plans, all of them have to be shown in the working notes. But let us start with the main answer first. What is going to be the earnings before interest and tax? This plant is expected to yield EBIT of 5 lakhs. That is common for each of the alternatives. 5 lakhs, 5 lakhs, 5 lakhs. Now comes interest. In alternative 1, how much is the interest? First of all, how much is the debt? Debt is 2,50,000. Up to 2,50,000, debt can be taken at a rate of interest of 10%. So 10% of 2,50,000 will be 25,000. That is the interest in first scenario. Then second scenario, debt is 10 lakhs, but here there are two slabs per debt. So this has to be calculated separately. Up to 2,50,000, 10%, that is one thing, right? Up to 2,50,000, 10%. Still, how much debt is supposed to be raised? Another 7,50,000 is supposed to be raised. So up to 10 lakhs means over 2,50,000 and up to 10 lakhs, 15% is the rate of interest. So on the remaining 7,50,000, rate of interest applicable will be 15% as given in the question. So between 2,50,000 and 10 lakhs debt, rate of interest will be 15%. So what is the total interest in this situation? That will be 1,37,500. That can be taken. 1,37,500 as interest in alternate 2. Then coming to alternate 3, there also interest can be calculated, but here there will be 3 different slabs. One more slab is there. So up to 2,50,000, 10%. Anyway, then between 2,50,000 to 10 lakhs means 7,50,000, on that 15%. But how much debt is required? Beyond the 10 lakhs here, 5 lakhs is required. On that, how much rate of interest will be applicable? Over and above 10 lakhs, 20% rate of interest is applicable. In this case, 5 lakhs. On 5 lakhs, 20% rate of interest will be applicable. That means 1 lakh. Now, what is the total of all these three? This is a separate working note. 2,37,500. That will be the interest in alternate 3. So we have EBIT and interest. Then we get EBT straight away. EBIT minus interest. 4,75,000, 3,62,500, 2,62,500. Then tax. What is the tax rate? Tax rate is given as 50%. So 50%. 2,37,500, 181,250, 131,250. We need to calculate these things. Then coming to the earnings available to equity shareholders, because there is no other preference and all, straight away profit after tax will be earnings available to equity shareholders. That will be same amount as tax, because tax rate is 50%. So far, good. Now, number of equity shares will have to be now calculated carefully. So, number of equity shares, do we know what will be the issue price? Separately not given, but it is given that the price of the shares currently in the market is 150, but it is expected to decline to 125 if the funds are borrowed in excess of 10 lakhs. In other words, in alternate 1 and 2, since the borrowing did not cross 10 lakhs, the shares can be issued in the market. That is the only thing which is there. Issue price separately not given. So shares can be issued at 150 rupees per share. And you need how much money? You need how much ever money raised through equity. That divided by 150 will be the number of equity shares. So what is the number of shares in alternate 1? 22,50,000 you require from equity divided by 150 means you have to issue 15,000 equity shares in alternate 1. In alternate 2 also, whatever the amount to be raised by equity divided by 150 means 10,000 equity shares are to be raised in alternate 2. But when it comes to alternate 3, since the amount borrowed has crossed this 10 lakhs, in excess of 10 lakhs, the price of the share will be declining to 125 only. So if it is declining to 125 only, that means what will be the number of shares supposed to be issued? 10 lakhs amount to be raised through equity divided by 125 only. That means 8,000 shares are to be issued in alternate 3. That's all. We have earnings available to equity shareholders. We have number of shares. All that you need to do is earnings available to equity shareholders divided by number of shares. You will get EPS. Again, incidentally, in this case, which alternative has got the best EPS? Alternative 2. Because it has highest EPS, plan 2 will be better. So 15.83, 18.13 and 16.41 is the answer. Main point once again in the examination, you have to clearly write what are these plans and you have to also clearly show the main answer anyway. In addition to that, computations in the form of calculation of interest on debt and number of equity shares both are to be shown as working notes. Along with that working notes, you will get full marks. That is another application of EBIT EPS analysis. Now, look at illustration 13. Following data are presented in respect of Quality Automation Limited. Profit before interest and tax, 52 lakhs. Interest on debentures is 12 lakhs. Profit before tax is 40 lakhs naturally. And income tax is given 50%. Profit after tax, number of equity shares, EPS, PE ratio 10. So market price will be EPS multiplied with PE ratio, that is 25. So everything is given already. Now the company is planning to start a new project requiring a total capital outlay of 40 lakhs. You are informed that a debt equity ratio clearly given. Debt equity ratio normally means debt by equity, but here it is debt by debt plus equity. If that is higher than 35%, it will push the KE up to 12.5%. Naturally, if KE is 12.5%, that means how much will be the P ratio? It need not be given also. Reciprocal of that. That will be 8 times. And raises the interest rate on additional amount borrowed at 14%. Normally, what is the rate of interest now? 12%. So, in case a debt equity ratio, which is debt by debt plus equity, is increased beyond 35%, then these changes will happen. Means P ratio will reduce and additional amount that is supposed to be borrowed will have to be borrowed at 14%. Now, what is this? Asked. Find out the probable price of share. Probable price of share means market price of share, how much it could be. That has to be calculated if the additional funds are raised as a loan or if the amount is raised by issuing equity shares. Only two things are there. Retained earnings of the company is 1.2 crores. That is already there. So, first thing first, if the amount is raised as equity shares, we don't have to worry about debt by debt plus equity ratio and all. But if it is raised as loan, certainly maybe it will cross the 35% limit as given in the question. For that purpose, before going to anything else, first let us understand what is the existing capital structure of the company. That is important. First of all, what is the existing capital structure of the company? Number of equity shares are 8 lakhs and 10 rupees each is the equity shares. That means what? 80 lakhs rupees is the equity share capital. Retained earnings as given in the question 1.2 crores. That means 1 crore 20 lakhs. Then interest at the rate of 12% is 12 lakhs. So naturally we can find out how much would be the existing debt. Existing debt would be 1 crore. Then only 12% rate of interest will be 12 lakhs, right? So 1 crore will be the existing debt. So what is the total of this, which is debt plus equity? That is 3 crores. You can do all of these things in lakhs also. 80, 120, 100. So 200 plus 100, 300 lakhs is what? Debt plus equity. Now what is debt by debt plus equity? Currently, we'll come to the fresh project later. Currently what is D by D plus E? 1 by means 100 by 300. 1 by 3. So 1 by 3 naturally means 33.33%. Already 33.33% is the debt by debt plus equity ratio. Let us call it as debt equity ratio. It is also one of the formula for debt equity ratio, so we can call that also. So currently debt equity ratio is only 1/3, that is 33.33%, which is okay. And if you raise new funds through equity, then debt equity ratio will not increase, rather it will decrease, because denominator is increasing, numerator is not increasing. So second scenario, there is no way that debt equity ratio will change. But in first scenario, will debt equity ratio change? Of course it will change. Because what is a new plan? New money that is required 40 lakhs. So additionally you require 40 lakhs. So if the debt by debt equity ratio crosses 35%, automatically there are some things that will change. First let us check whether that crosses or not. Of course it will cross. Why? Because 40 lakhs is a big amount. Now what is the new debt? It is not going to be 100 anymore. It is going to be 140 because you are raising everything through debt. So 80 plus 120. 80 is already there as equity. Then 120 is already there. That is retained earnings. Plus 140. So now it becomes 340. Denominator becomes 340. Numerator becomes 140. That is debt by debt plus equity. So 140 by 340. That is naturally 41.2%. Which is obviously more than 35%. Which means this new debt, when it is issued, automatically there are going to be some changes. What are the changes? 1, P ratio will come down to 8. Interest on the additional amount borrowed will be 14%, not 12%. That is a point here. After noting these things and after showing these things in the working note, with the new fresh investment, how much extra return will come, that is not given. That we cannot take the same profit before interest and tax because it is existing. 52 lakhs is existing. So 52 lakhs if you are making on a total investment of 3 crores, that means 52 by 300. What is your current return on investment? 52 by 300. That is around 17.33%. That is 17.33%. So if the same return is expected, naturally, because no information is given on that, on how much now it is going to be 340. So new fund is going to be raised for 40 lakhs. Extra return that comes from these new funds is not given. So that will be how much that we can find out straight away. On 340, how much will be the EBIT? So on 340 lakhs multiplied with 17.33%, that comes to, first of all, in this case there are only two alternatives. How much EBIT will be there? 58,92,200. 58,92,200. You cannot take 52 lakhs because when you are investing 40 lakhs, you will get some return also. It cannot be just giving the same return. So how much return it will give, because it is no information is given on that, we have to assume that same return on investment will be there. On the existing investment of total 300 lakhs, you are getting 52 lakhs. How much you would get on 340 lakhs? You will get 58,92,200. That will be same in both the alternatives, whether you raise it by loan or whether you raise it by equity. So first option is alternate 1, loan. Second option is equity. Then in first option, of course 12 lakhs interest will continue, that will not change. But on the additional loan, which is entirely 40 lakhs, rate of interest applicable is 14%. So 12 lakhs is anyway there. On top of that, on 40 lakhs, 14% interest will be there. So what is going to be the additional interest? That is 5,60,000. That is in addition to the existing 12 lakhs. Anyway, it will continue. So total interest in that case will be 17,60,000. So 12 lakhs already there, 5,60,000, which is 40 lakhs multiplied with 14%. Total interest will be 17,60,000. In alternate 2, since you are raising fresh finance only through equity, interest will continue to be same 12 lakhs. Nothing extra will be there. So this all extra interest is not there. Only 12 lakhs interest will continue. Now what will be the earnings before tax? Naturally, EBIT minus interest. Then what is tax rate as given in the question? 50%. So 50% of EBT will be the tax. Then what will be the earnings available to equity shareholders, which is profit after tax in this case, since there are no dividends, preference dividends are not there. So obviously same profit after tax will be earnings available to equity shareholders. Then comes naturally number of equity shares. In alternate 1, the number of equity shares will continue to be 8 lakhs because no new shares are issued, everything freshly raised as debt only, new loan only. But in alternate 2, what happens is equity shares have to be issued, 40 lakhs rupees freshly to be taken. And what is the market price per share currently, at which rate you have to issue them? Naturally 25 rupees. So how many number of new equity shares are supposed to be issued? 40 lakhs divided by 25. 1,60,000 equity shares are supposed to be freshly issued. Already there are 8 lakhs plus 1,60,000 new shares are supposed to be issued, means 9,60,000 shares are supposed to be issued. Then obviously the EPS will come by taking earnings available to equity shareholders divided by number of equity shares. Then 2.58 and 2.44 will be the EPS, and that is not just what is asked here. What is asked here? Price of the share, probable price of the share has been asked. So how much will be the probable price of the share? How do we know that? EPS has to be multiplied with PE ratio. It has to be multiplied with PE ratio. So how much is PE ratio in alternate 1? Now that is an important point, because in alternate 1, since the debt is used, the condition of debt equity ratio crossing more than 35% has been satisfied, which means P ratio now becomes only 8. But in alternate 2, P ratio will continue to be 10 because no debt is issued, since same debt equity ratio of 33.33% will be continued, or actually less than that will be there. Debt equity ratio will be less than that, because in the new scenario the debt equity ratio will be 240 by 340, that means 70%, so which is good. That means only 30% debt, so 100 by 340, so 29% only will be debt equity ratio. Anyway, it will be less than 33.33%, definitely less than 35%, so no change in P ratio will happen. So obviously what is going to be the market price per share? So 2.58 EPS multiplied with this, that will be the market price per share. So if you take decimals, 20.66 and 24.44, that is going to be the market price per share. So obviously what is the best option now? In this scenario, equity is the best option because it is giving better market price per share. So all these workings have to be obviously shown. And finally, what is the probable market price per share? That is 20.66 and 24.44. That's it. That is the decision. Of course, if you observe, EPS is more in option 1, but market price per share is more in option 2. So which has to be looked at? Market price per share. So final target of any company, objective of the financial management is maximization of wealth, which is nothing but market capitalization, which can be only maximized with more market price per share. So obviously this will be 24.44 better market price per share. That's all. That is the illustration given in the ICA material, illustration number 13. These are some of the numerical questions related to EBIT, EPS analysis. Now coming to another important theoretical question, overcapitalization and undercapitalization can be asked as a theoretical question. See, simply overcapitalization means what? As the name indicates, when the company is taking more capital than it needs. In other words, assets are worth less than its issued capital. Earnings are insufficient to pay dividends and interest. That situation arises where the existing capital is not effectively utilized. That means the company is not doing performance efficiently and effectively. That is called overcapitalization. So overcapitalization arises due to the following reasons. So the question can be, what are the causes and remedies of, or causes and symptoms of overcapitalization? Causes can be: 1, raising more money through issue of shares and debentures than they require or than they can employ profitably. Second thing, borrowing huge amount at a very higher rate than what the company can earn. Huge debts, big debts at huge rates of interest. Then excessive payment for acquisition of assets like fictitious assets, not actually fictitious but definitely intangible assets like goodwill, possible. That is one of the reasons. Improper provision for depreciation, replacement of assets, or even distributing dividends at very higher rate, not retaining earnings properly. Wrong estimation of the earnings and wrong estimation of capitalization. So these are all possible causes for overcapitalization. And what are the consequences? Naturally, when the overcapitalization is there, profits will not be sufficient to service the capital. So what happens? Considerable reduction in the rate of dividend and interest payments will happen. Obviously, because of that, reduction in the market price of shares will happen, and companies start to resort to window dressing. One of the examples of this was Satyam Computers case, where they started to window dress their financial statements. Window dressing basically is showing wrong figures, almost cheating. It's a criminal offense. And some companies may have to go for reorganization. Then, if the matters go worse, maybe the company even can go into liquidation. That is the danger of overcapitalization. These are all various consequences of overcapitalization which are possible. Now, what can be the remedies for overcapitalization? Either the company can go for reorganization, or buyback of shares if it has cash sufficient, or reduction in the claims of debenture holders and creditors, again if it has cash, and value of the shares may also be reduced. But of course, that will result in sufficient funds for the company to carry out the replacement of assets. If it does any of these things, overcapitalization can be little bit adjusted. But practically, once a situation is out of control, these all remedies are not going to really work. They are going to be useless. If the situation is still within control, then any of these remedies can create a bit of benefit to the company. These are various aspects related to overcapitalization. So what is overcapitalization, what is undercapitalization is a theory question. So same like overcapitalization, the opposite of overcapitalization is undercapitalization, where actual capitalization is lower than its required money. So its earning capacity is good, but it is not having sufficient capital. So what is happening here in this case? In this case, the company is having insufficient capital, but it has large secret reserves in the form of considerable appreciation in the value of fixed assets, which are not brought to the book. So company is actually having a very good value, but it is having a less book value and less capital. So this results in the following consequences. One, dividend rate will be higher in comparison to the similarly situated companies. Second, market value of the shares will be higher than the value of the shares of similar companies, because actually they are having a lot of good secret reserves. So that is another situation. Or real value of the shares will be higher than the book value. Obviously it will be higher. These are the possible consequences of undercapitalization. Effects or consequences, both are same. But what can be the effects of this undercapitalization? It encourages competition. So high profitability encourages new entrepreneurs to come into this type of business because it looks very lucrative. High rate of dividend encourages the workers' unions to demand high wages, possible. Normally, the common consumers start feeling that they are being exploited because the company is able to generate good profits more than what they have the capital. So the capital of the company is so small, but the profits of the company are too much. How? That creates a doubt in the minds of the shareholders and consumers. Then management may resort to the manipulation of share values sometimes. Again, it is illegal. And might invite more government control and regulation on the company and higher taxation also, possibly. These are the various effects of that. Remedies of this can be, the shares of the company should be split up. This will reduce the dividend per share, though EPS will remain unchanged. So dividend per share at least will reduce if the split up happens. Split, share consolidation, both are possible. So face value of the share, if it is 10 rupees, let us say if you divide that into 5 shares of 2 rupees each, that can be one of the things where the face value of the share and market price of the share also will look reasonable. Then issue of bonus shares is another remedy for this. Or by revising the upward par value of the shares in exchange of existing shares held by them. That is not practically possible, but if that happens, that can be considered as one of the remedies. So companies cannot just like that increase, decrease their par values at their will. There are a lot of regulations for that. So can't happen like that. But point is, both the undercapitalization and overcapitalization are not really good. Both of them are not considered to be a good situations. What is the best capital structure? Obviously, somewhere in the middle. Means a balanced capitalization is required. A balance is required. Always in financial management, that's what is the objective. To keep a balance, trade-off between two extremes. Both extremes will be always dangerous. There has to be a trade-off between both extremes. Then naturally the company will be reasonable in its performance, capital structure, and not only that, market perception about the company also will be better. If it has overcapitalization or undercapitalization, definitely the market is not going to look at the company in a positive manner. Undercapitalization is something which the market looks at the company with a doubt. Overcapitalization is a situation where the market looks at the company as if it is going to die soon. So both will not be taken positively by the market. So that is the risk of these two different possibilities. Both of them are not good. Balance of them is required. That's it. That concludes this chapter of capital structure, consisting of capital structure theories, also the EBIT, EPS and indifference analysis. And we solved some of the problems already which are there within the chapter. Now let us continue to solve some more questions which are there at the end of the chapter. Now look at problem number 1. Aina Limited is considering a new project which requires a capital investment of 9 crores. Interest on the term loan is 12%. Corporate tax rate is 30%. Calculate the point of indifference for the project, considering that the debt equity ratio insisted by the financing agency is being 2:1. See, when we talk about indifference point, obviously there have to be two options. So what are the two options which are available here? One, you can raise the entire 9 crores through equity, because that is the 9 crores which is required. Entire amount through equity, that is option 1, we can call it. Or we can raise it through a mix of debt and equity. But since the financing agencies are insisting on 2:1 debt ratio, so debt should be 2, equity should be 1. That means debt should be 6 crores, equity should be 3 crores. That is the second option. And naturally, when debt is 6 crores, interest on the debt being 12% will be 0.72 crores. 12% rate of interest, 6 into 12%, 0.72 crores. That is one thing. So when we talk about indifference point, we have to use the formula for indifference point. We have to find out that EBIT at which both the options will give same EPS. That is the point of indifference. So EBIT minus I1, if any, into 1 minus tax rate divided by N1 should be equated to EBIT minus I2 into 1 minus tax rate divided by N2. We have to have all the other points here. So interest in option 1 is 0 because there is no debt. Interest in option 2, I2 is 0.72, we already know that. Tax rate is already known, which is 30%. N1 and N2 are supposed to be known. So here N1 means number of equity shares in option 1. What is the face value of the equity shares is not given. That doesn't matter. If you assume anything, ultimately answer will be same because you are going to use the same face value for both the options. Let us say, for example, if the face value is 1 rupee or 10 rupees or 100 rupees, whatever you can take it. If the face value is 1 rupee, let us say, then 9 crores shares will be issued. On the other side, let us say if you take face value 10 rupees, then 0.9 crores equity shares will have to be issued in option 1. Anything can be taken. Okay, let us take 10 rupees face value. That means option 1, N1 will be 0.9 crores number of shares of 10 rupees each, so that it will give 9 crores rupees of capital. Naturally, option 2 will be only having 3 crores of equity, which means you need to just raise 0.3 crores of new equity shares. So we have everything. All that we need to do is substitute. EBIT is what we have to calculate. In first case, there is no interest. 1 minus tax rate will be 0.7. Then EBIT minus I2 we already know, 0.72 crores. All in crores we are taking into 0.7, 1 minus tax rate. In first case, N1 is 0.9. In second case, which is N2, 0.3. So we have to solve for EBIT. We can just cross multiply. So 0.3 multiplied with 0.7, that means 0.21 EBIT. This is cross multiplication. Should be equal to EBIT minus 0.72, anyway is there. Then 0.9 cross multiplied with 0.7 will be 0.63. So let us expand this. 0.63 EBIT minus 0.63 into 0.72. 0.4536. So bring the left hand side EBIT to the right hand side and bring the negative amount number to the other side. So 0.4536 will be equal to 0.63 minus 0.21, which is 0.42 EBIT. Then naturally EBIT will be equal to 0.4536 divided by 0.42. That will be 1.08 what? Crores. Because we have taken everything crores, EBIT answer also will be in crores. That's it. That is the answer for question number 1. That is the point of indifference between pure equity and debt and equity with a ratio of 2:1. Now moving on to second question. Xylo Limited is considering two alternative financing plans, Plan A and Plan B. Equity shares of 10 rupees each, 8 lakhs rupees. That means naturally automatically 80,000 equity shares. Number of equity shares will be 80,000. Then Plan A has debt, Plan B has preference shares. Equity is same. So Plan A is to raise the financing by 12% debentures. Plan B is to raise the 4 lakhs required capital by issuing preference shares of 100 rupees each. Indifference point between the plans is 4,80,000. So here indifference point is already given. Corporate tax rate is 30%. Calculate the rate of dividend on preference shares. So it is like a reverse calculation because indifference point is already given. So all that we need to know is what will be the preference dividend. Naturally only in Plan B that will be there. We can use the formula also, or we can just calculate what will be the indifference point. According to that, what will be the earnings available to equity shareholders. All of that can be done. So let us just use a simple statement format. Plan A, Plan B. EBIT is the indifference point, right? So that is given already, which is 4,80,000 in both cases. Then interest. Interest is there only in Plan A, 12% debentures on 4 lakhs rupees, 12% means 48,000. In second case, there will not be any interest. So what is going to be the EBT in A, Plan A, 4,32,000. Plan B, same 4,80,000. That is earnings before tax. Deduct tax. What is the tax rate given? 30%. So 4,32,000 into 30% means 1,29,600. So 432 minus 30%. What is the profit after tax? 3,02,400. Same way, 30% on 4,80,000 will be 1,44,000. That is a tax. Then remaining will be 3,36,000. That is profit after tax under Plan B. Now, as far as Plan A is concerned, same 3,02,400 will be the earnings available to equity shareholders because there is no preference dividend. So, earnings available to equity shareholders 3,02,400 divided by number of equity shares. Number of equity shares is 80,000. That will be equal to EPS. So 3,02,400 divided by 80,000, EPS is 3.78. When you say indifference point, that means both options have same EPS. So option B also should have had same EPS. In other words, option B should have Same earnings available to equity shareholders also, which is 3,02,400. How is it possible? How is it possible when your profit after tax is 3,36,000, but earnings available to equity shareholders is 3,02,500? Naturally, the remaining amount has to be preference dividend. How much is that? Balancing figure. That should be 33,600. Then only profit available to equity shareholders will be same as plan A, which is 3,02,400. So now we have the preference dividend. That's what is asked. Rate of dividend is asked, not the dividend. Rate of dividend is asked. Okay, we can find out rate of dividend because 33,600 dividend is there for 4 lakhs worth of preference shares. So 33,600 divided by 4 lakhs into 100. So the rate of preference dividend is 8.4%. That's it. That is a requirement in question number 2. Quite possible to be asked for a 5 marks question. Then, moving on to question number 3. Ganesha Limited is setting up a project with a capital outlay of 60 lakhs rupees. It has 2 alternatives in financing the project cost. First one, which is alternate 1, 100% equity finance by issuing equity shares of 10 rupees each. Alternative 2, debt equity ratio of 2:1, issuing shares of 10 rupees each. Again, debt equity ratio 2:1 means should be 40 lakhs and 20 lakhs. 40 lakhs debt, 20 lakhs equity. That is alternate 2. Rate of interest payable is 18%, corporate tax rate is 40%. Calculate the indifference point between the 2 alternative methods of financing. Almost a straightforward question. We can use the formula easily. EBIT is what we are supposed to calculate. In option 1, there will not be any interest. So directly, we will take 1 minus tax rate. Let us take 1 minus tax rate also directly. That will be 0.6. Divided by N1, number of equity shares in the first scenario. How many will be? Because you need 60 lakhs. Entire money is raised by equity. 10 rupees per share means 6 lakhs will be the N1. You have to show these workings in the exam as working notes. What about option 2? EBIT is what we have to calculate. Minus I2. Interest will be there in plan 2 or alternate 2 because 40 lakhs debt is there. So on 40 lakhs, what is the rate of interest? 18%. That means 7 lakhs 20,000. 7 lakhs 20,000 is the interest. 18% on 40 lakhs. 7 lakhs 20,000. Multiplied with 0.6. That is common. Divided by number of equity shares here in alternate 2 will be only 20 lakhs divided by 10. That is 2 lakhs. Okay. See, we can just forget about these zeros. Those 2 can be just nullified. This 2 can go this side, 6 can come this side. So 2 multiplied with 0.6. 1.2 EBIT. In exam, you can elaborate these steps a little bit. If it is a 5 marks question. So 1.2 EBIT will be equal to, what is in bracket? Keep it as it is first. EBIT minus 7,20,000 will remain as it is. 0.6 multiplied with 6. 3.6. So expand it. 3.6 EBIT minus 720,000 into 3.6 will be 25 lakhs 92,000. Now bring the 25 lakhs 92,000 to this side and bring 1.2 to the other side. So 3.6 minus 1.2 will be naturally 2.4 EBIT. So 2.4 EBIT is equal to 25 lakhs 92,000. How much will be EBIT? Naturally 25 lakh 92,000 divided by 2.4. That comes to 10 lakhs 80,000 rupees. That is the indifference point, which means if the company Ganesha Limited can earn an operating income of 10 lakhs 80,000, it doesn't matter which capital structure it chooses. Both ways, EPS of the company will remain same. That is the indifference point. That was question number 3. Now, question number 4. Ganpati Limited is considering 3 financing plans. Information is like this. Total investment to be raised is 2 lakhs. Plans are given like this. Plan A is 100% equity. Plan B, 50% equity, 50% debt. Plan C, 50% equity and 50% preference shares. Then other information is given. Cost of debt is 8%. Cost of preference shares is also 8%. Tax rate is 50%. Then equity shares of face value of 10 rupees each will be issued at a premium of 10 rupees per share, which means issue price is 20 rupees. First we have to identify that. Expected EBIT is 80,000 rupees. First thing first, you are required to determine for each plan earnings per share, then financial break-even point. Then third question says indicate if any of the plans dominates and compute the EBIT range among the plans for indifference. So indifference points between different plans also has to be calculated in the third question. First let us start with computation of EPS. So 3 plans are there. Heading should be there naturally. Statement showing computation of EPS. Plan A, Plan B, Plan C. EBIT is common. That is 80,000. That has nothing to do with the capital structure. That is operating income. Then interest. Plan A, does it have any interest? No. Plan C also doesn't have any interest. Plan B only has interest, which is 50%. Debt, in the sense, how much is supposed to be raised? 2 lakhs. That means in that 1 lakh will be raised as debt. On 1 lakh, rate of interest as it is given is 8%. Okay. So here interpretation wise it can be taken like this. Cost of debt is given, not rate of interest. Imagine if you interpret like cost of debt is after tax cost of debt, then you can take this as 16% also. That is also okay. Either way it can be taken, because if it is interest rate, it should have been given as interest rate. Normally, not cost of debt. Either way it is okay. So we can choose any of them. Just let us take a plain interpretation. Cost of debt is interest rate, not an after tax cost of debt and all that. So 8% only we are taking. 1 lakh into 8% means 8,000 rupees. Then what will be EBT? Same in plans A and C. Here it will be 72,000. Then you have tax. That is 50% tax rate means 40,000, 36,000, 40,000. Then profit after tax 40,000, 36,000, 40,000. Then you have to reduce preference dividend. In A and B there is no preference dividend, but in C there will be preference dividend, which will be how much? 8% preference dividend. So 8% on 1 lakh will be 8,000. So what is the earnings available to equity shareholders? 40,000, 36,000, 32,000. Then number of equity shares in plan 1, since entire 2 lakhs is going to be raised through equity, issue price is 20 rupees. So 2 lakhs divided by 20 means 10,000 shares will be issued in plan A. Plan B, only 1 lakh is raised through equity, 50% only is raised through equity, which means 1 lakh rupees only to be raised. So 1 lakh equity, for that with the issue price of 20 means we have to issue 5,000 equity shares. Plan C also 5,000 equity shares only, because there also amount raised through equity is 1 lakh rupees. Now what is the EPS? That's what is asked. 40,000 by 10,000, 4 rupees. 36,000 divided by 5,000, 7.2. Then 32,000 divided by 5,000, 6.4. That is the EPS, and that is the question number 1. Second question asks about financial break-even point. Financial break-even point means what? First of all, we should know that it is the level of earnings where that earnings should be sufficient to meet the fixed financial charges like interest or preference dividend. So obviously for plan A, there is no financial break-even point. Even if the company gets 0 rupees profit also, it's okay because there is no debt. So for plan A, financial break-even point is nil, 0. For plan B, how much will that be? 8,000 rupees, because it has to pay an interest of 8,000 rupees. If it pays an interest of 8,000 rupees, then it is okay. In that case, EBT will be 0. Break-even point means where there is no profit, no loss. So that is the financial break-even point for plan B. But for plan C, you have to pay preference dividend of 8,000. However, preference dividend is also one of the fixed charges, though it is not an interest, but it is also a fixed financial commitment. In order to pay 8,000 preference dividend, how much income you have to earn? 16,000. Why? Because tax rate is 50%. So if the EBIT, if the income is 16,000, then earnings after tax will be 8,000. That will be sufficient to pay preference dividend. So point is, in plan A, if the company gets a 0 operating income also, there is no problem. Still there will be no profit, no loss. In plan B, it has to get 8,000 profit EBIT so that the final profit figure will be 0. Whereas in plan C, the income or EBIT that is supposed to be earned by the company will be 16,000. Then only the final profit will be 0. EPS will be also 0 in that case. That is financial break-even point. So the level of operating income at which the company or equity shareholders will not have any income, no profit, no loss. That is financial break-even point. Or the income that is required by the company to meet its fixed financial obligations like interest and preference dividend also. That can be called as financial break-even point, and we calculated that. That is question number 2. Third question asks, if any plans dominates, and what is the EBIT range among the plans for indifference? So there are possibilities here, combinations. There can be an indifference point between A and B. There can be an indifference point between B and C, EBIT, and there can be an indifference point between A and C. So all 3 indifference points we have to find out. Let us find out first between A and B. What is indifference point? EBIT. Because in plan A there is no interest, directly 1 minus tax rate, and the tax rate is 50%. So 0.5 divided by N1, number of equity shares in plan A. We know that already. That is 10,000. That should be equal to EBIT minus interest. Here interest in plan B is 8,000 into 1 minus tax rate divided by 5,000. What is the level of EBIT at which A and B plans will have indifference point? Same way, forget about these thousands. Sorry. So 5 and 10. So 5 into 0.5, 2.5 EBIT will be equal to 5 multiplied with EBIT minus 8,000. How 5? Is 10 multiplied with 0.5, that is 5, cross multiplication. So this is equal to 5 into EBIT minus 40,000, which means 2.5 EBIT will be equal to 40,000. How much will be EBIT? Indifference point. So 40,000 divided by 2.5, 16,000. So between plan A and plan B, the point of indifference is 16,000. That is first thing. Second thing, between B and C. B and C. Here B is debt, C is preference. So EBIT minus 8,000 interest into 1 minus tax rate divided by 5,000, that will be equal to, be careful, here there is no interest, but EBIT into 1 minus tax rate minus preference dividend, that is 8,000 divided by 5,000. These two will go. Now what it comes out to be is 0.5 EBIT minus 4,000 is equal to 0.5 EBIT minus 8,000. Is it possible? Impossible. Impossible, because 0.5 EBIT, 0.5 EBIT, if they go, can 4,000 be equal to 8,000? It doesn't make sense. Which means what? Doesn't make sense means there is no point of indifference between plan B and plan C. That is the conclusion. No indifference point. We checked that already. There is no necessity that always there will be indifference point. Sometimes indifference point may not be there. This is such situation where B and C do not have any indifference point. Then we can also calculate A and C indifference points. A is pure equity. Once again, EBIT into 1 minus tax rate, because there is no interest anyway, divided by 10,000 should be equal to C is also EBIT into 0.5 minus preference dividend. No interest there also. But preference dividend 8,000 is there. That will be the earnings available to equity shareholders divided by 5,000. So cross multiply. 5 into 0.5. 2.5 EBIT will be equal to 10 into 0.5, 5 EBIT, because this entire thing is going to be multiplied with 10 minus 40,000, sorry, 80,000. 10 into 8,000, 80,000. So 2.5 EBIT is going to be 80,000. How much is going to be EBIT? Divided by 2.5, 32,000. Means the indifference point between plans A and C is 32,000. So that is one thing asked. And also asked if any plan dominates. If any of the plans dominate. Yes, of course. Which plan is best? Naturally, B is best. Why? Because it has the highest EPS. Which plan dominates? B dominates. So that is the answer for third question. And indifference points between different combinations also we calculated. That's what was asked in this third sub question of question number 4. Now moving on to question number 5. EOL Limited presently has 36 lakhs rupees in debt outstanding, bearing an interest rate of 10%. It wishes to finance a 40 lakhs rupees expansion program and is considering 3 alternatives. Additional debt at 12% interest, preference shares with a 11% dividend, equity shares at 16 rupees per share. The company presently has 8 lakh shares outstanding and it is in a 40% tax bracket. All the details are given. First point. If earnings before interest and taxes are presently 15 lakhs, determine earnings per share for the 3 alternatives assuming no immediate increase in profitability, which means same profitability will be continued. Then also asked, analyze which alternate do you prefer, compute how much would EBIT need to increase before next alternative would be best. Well, that will be calculated later. First of all, what is required is, currently what is the existing capital structure? First of all, let us check that. It has 36 lakhs in debt and 8 lakhs equity shares are there, and face value of the shares is not given. Let us take market values, no problem. 8 lakhs into 16 rupees, let us say 128. 128 is the equity at market value of the capital structure. So 128 plus 36 lakhs rupees debt means total capital as of now is 164. On this, how much EBIT currently it is getting? 15 lakhs. So 15 divided by 164 means currently it is getting around 9.15, let us say, percentage of return on its investment. The investment here, since the face value and retained earnings, other details are not there, we have taken market value, which is more appropriate. So 8 lakh shares with market value of 16 means that itself can be taken as the investment. On that investment, the return is 9.15%. That will continue. So all that we need to do is EPS calculation in 3 different financing options. So let us call option 1, option 2, option 3. Statement showing evaluation of 3 different financing alternatives. All those headings have to be put. First option is what? Additional debt, 12%. So what is the extra amount that is required here? 40 lakhs. So first of all, we have to understand how much extra EBIT will be generated on 40 lakhs. So on 40 lakhs, if you take 9.15% rate of return, 3,66,000 extra will come. That means 18,66,000 will be approximately the EBIT after the financing plan and investment plan are implemented. 15 lakhs already there and 3,66,000 extra EBIT that comes from new investment. How did you know that? 9.15% of 40 lakhs, that is 3,66,000. So total 18,66,000 is the EBIT. Then deduct interest from that. Interest is there in the first option. Obviously, currently there is interest of 3,60,000, 10% debt, and extra 40 lakhs if you raise it with 12% debt, interest will be 4,80,000. So 480 plus 360, total interest will be 8,40,000. You have to show all these things in the working notes. Interest calculation, return on investment calculation, application of that to find out the fresh EBIT that will be generated with the investment. Everything has to be shown in the working notes. Now we are just taking the final answers here. Now second alternative is what? Preference shares only. That means no extra interest is there, but existing interest will continue. That is how much? 3,60,000. That will continue. Same with third alternative also, because equity shares are going to be issued. There also existing interest will continue. There will not be any change in that. Now naturally what is going to be? Earnings before tax. 1866 minus 840. 10 lakhs. 26,000. Second scenario. 1866 minus 360. 15 lakhs. 6,000. That will be same in the third also, because same amounts are there. That is EBT. Deduct tax. What is the tax rate given? 40%. So calculate tax. 6 lakhs 2,400. 6 lakhs 2,400. Remaining will be 9 lakh 3,600 in both the options 2 and 3. But option 1 is different. 10 lakhs 26,000 into 40% will be 4 lakhs 10,400. And profit after tax will be 6 lakhs 15,600. That is profit after tax. From that you have to reduce preference dividend, which is not there in option 1 also and option 3 also. It is there only in option 2. That is 11% preference shares are going to be issued. So on 40 lakhs rupees, 11% means 4,40,000 rupees you have to pay preference dividend. 40 lakhs rupees, 11% preference dividend. Then naturally what will be the earnings available to equity shareholders? 6 lakhs 15,600, 4 lakh 63,600, 9 lakhs 3,600. This is earnings available to equity shareholders. divided by number of equity shares has to be given. In option 1, no fresh equity is issued. That's why same 8 lakhs will be the number of equity shares. Option 2 also no fresh equity shares are there. That means same 8 lakhs number of equity shares will be there. But in option 3, definitely number of equity shares will increase. Because you are issuing 40 lakhs rupees of finance with a 16 rupees of issue price. 2,50,000 extra shares have to be issued. 40 lakhs divided by 16 rupees. So 2,50,000. Add that to 8 lakhs. 10,50,000 number of shares will be there in option 3. That's all. All that we need to do is EPS calculation. Do that. 615,600 divided by 8 lakhs. 0.77, let us say 2 digits. 4,636,600 divided by 8 lakhs. 0.58, let us say, and 9,03,600 divided by 10,50,000. That comes to 0.86. So 0.77, 0.58, 0.86. That is the EPS under 3 different alternatives. Obviously, which alternative is better? Alternate 3 is better because that is giving best EPS. So which alternate do you prefer is the question. So if at all, how much EBIT will be needed to increase before the next alternative would be best? So now alternate 3 is better. Next best alternative is what? Alternate 2. Right? We can find out the indifference point between these two alternatives. At which level of EBIT these two alternatives will give same EPS. Let us calculate that. EBIT minus interest 8,40,000 into 1 minus tax rate. Tax rate is 40%, so 0.6 divided by number of equity shares 8 lakhs. That should be equated to EBIT into tax rate directly, because there is no interest, no preference dividend also in alternate 3, divided by 10,50,000. So cross multiply. 0.6 EBIT minus 840 into 0.6, 5,04,000 whole multiplied with 10.5, let us say, lakhs. That will be equal to 0.6 EBIT multiplied with 8. So 0.6 into 8, 4.8 EBIT. Now 10.5 multiplied with 0.6, 6.3 EBIT minus 5,04,000 into 10.5, 52,92,000 is equal to 4.8 EBIT. So bring that 4.8 to this side. 6.3 minus 4.8 will be 1.5 EBIT will be equal to 52,92,000. So naturally, how much will be EBIT? 52,92,000 divided by 1.5. That is 35,28,000. What was the EBIT we took? Only 18,66,000. So what was the question? How much would EBIT need to increase before the next alternative would be best? So how much extra EBIT will be required over and above what we already took? How much extra EBIT is required so that the next alternate, which is alternate 1, will become best, so that then the graph will change. Then onwards, alternate 1 will be better than equity. So normally in the initial stages, equity will be better. If EBIT increases more and more, then debt will be better. So 18,66,000 is already there. Question is asking how much extra EBIT will be required. 18,66,000. If you reduce from 35,28,000, that is what is required to bring debt also on par with equity option, so that EPS is same in both cases. Afterwards, debt will become better. So what is the difference between them? 16,62,000 rupees will be the additional EBIT that is required before next alternate would be best. That's it. That is B question. Very good question. Such kind of questions can be very well expected in the examination. Now a similar question, question number 6. Alpha Limited requires funds amounting to 80 lakhs for its new project. To raise the funds, the company has following two alternatives: to issue equity shares of 100 rupees each at par amounting to 60 lakhs and borrow balance amount at an interest rate of 12% per annum. Both debt and equity are there, but composition is given. Second alternative is to issue equity shares of 100 rupees each at par and 12% debentures in equal proportion. Equal proportion means both are 40 lakhs. So first one is 60 lakhs equity, 20 lakhs debt. Second one is 40 lakhs equity, 40 lakhs debt. That's first we have to understand. Now what is asked here? What is the point of indifference between the available two modes of financing, and state which option will be beneficial in different situations? Anyway, first let us find out indifference point. Indifference point formula can be directly applied here. EBIT is what we have to calculate. Minus I1, interest in the first alternative will be how much? 20 lakhs rupees debt to be raised at the rate of 12%. So 20 lakhs into 12% means 2,40,000. That is I1. You have to show this calculation separately. Multiplied with 1 minus tax rate. Tax rate is 30%, means 0.7 is 1 minus tax rate. Divided by number of equity shares. So, number of equity shares will be how many? Because you have to raise 60 lakhs rupees through equity. 100 rupees is the face value of the share, and it is going to be issued at par only. So, number of equity shares here will be 60,000 in option 1. That's it. That should be equated to EBIT minus interest in option 2 will be 40 lakhs into 12%. 4,80,000. Multiplied with 0.7, that is same, divided by number of equity shares in option 2 will be how much? Here also at par 100 rupees shares are going to be issued. Total we need 40 lakhs finance, which means we have to issue 40,000 equity shares. So these zeros will cancel. Cross multiply. EBIT minus 2,40,000 should be multiplied with what? 0.7 into 4. 2.8. That should be equal to EBIT minus 4,80,000 in the bracket, that is there as it is. 6 multiplied with 0.7 will be 4.2. Just expand that. 2.8 EBIT minus 240 into 2.8. 6,72,000 is equal to 4.2 EBIT minus 20,16,000. Bring the 2.8 to this side. 4.2 minus 2.8 will be 1.4 EBIT. Bring this 20,16,000 to the other side. It becomes plus minus 6,72,000. That will be equal to 13,44,000. Now how much will be EBIT? 13,44,000 divided by 1.4. 9,60,000. So at a level of EBIT 9,60,000, both the financing options will have same EPS. That's what we call as indifference point. Now, also what is asked is which option is beneficial in different situations. Means different situations could be what? If EBIT is less than 9,60,000, which option is better? If EBIT is exactly 9,60,000, both options are better. If EBIT is more than 9,60,000, which option is better? Normally, when EBIT increases, more debt also will become good. So when EBIT is lesser, less debt is good. So obviously, below 9,60,000, option 1 will be better because it has less debt, only 20 lakhs debt. Yeah, to 9,60,000, both options are same. 1 and 2 both are better. Indifference point is there. But if the EBIT crosses 9,60,000, option 2 becomes better because of the debt being more. It gives financial leverage and it gives more return on equity. When that happens, only when EBIT is more. More than how much? More than the indifference point. So this is the conclusion that we can draw. At different situations, which plan is better? That's what is asked. That is question number 6. These are the various questions. 7th question already we have solved earlier. With that, we can conclude the discussion related to EBIT, EPS, MPS analysis and indifference point analysis also, which is a very popular question from the chapter of capital structure. So, capital structure theories or EBIT, EPS, MPS analysis, any of these questions can be asked in the examination. Practice them very well. And with that, we can conclude this chapter discussion related to capital structure. And we'll discuss about dividend decisions in the next session. Till then, take care. Bye-bye. Thank you very much.